The Fed leaving interest rates unchanged in May. For more reaction, we're going to bring in Michael Arone, Chief Investment Strategist at State Street Global Advisors, and Luke Tilley, Wilmington Trust Chief Economist and former Philadelphia Fed Economic Advisor. Luke, I'll start with you. Chair Powell has spoken. Luke, you were listening. What'd you make of it? What'd you learn?
He was talking pretty much in the way that we would expect, I think. You know, the statement said it clear, as we talked about a little bit over an hour ago, and that uncertainty has really increased on both the growth and the inflation side. And they seem very comfortable with their ability to react depending on which way it goes. And I think he was really trying to straddle the line and not show a tendency to go either direction. I think one of the more interesting things to me is that it sounded like, when given the opportunity, he did not take the next meeting off the table for action, for a cut. So at the previous meeting 7 weeks ago, when he was asked, is the May meeting, is today's meeting a possibility, he was pretty forceful and said, we are not in a hurry. And given a similar question today about whether action could be taken at the next meeting, he wasn't as forceful. He wasn't trying to communicate any kind of certainty there. And they're never going to say point blank that a meeting is off the table. But he sort of made it sound like it was possible. And I think that they're bracing themselves for what could be a pretty quick change when we see the tariffs flow through to activity and to labor market data.
Michael, if we do see the Fed that happening, that quick change in data, I guess I would ask, first of all, do you expect that to happen? And do you expect the Fed to be, if it does cut rates, how much is that actually going to help? I mean, I know you're more on the investor side than the economist side, but I'm curious to get your take.
So I don't think that the Fed will aggressively cut rates. It seems like it'll be a methodical approach to this. And I don't think that the data will change all that much between now and the next meeting. I think Chairman Powell kind of addressed that. Now, personally, I have two bones to pick with Chairman Powell. First, in November, he said that the Fed doesn't guess, doesn't speculate or assume. But yet when it comes to tariffs, that's exactly what they're doing. They're assuming that tariffs are inflationary. And in fact, that wasn't the case in 2018. They were not inflationary. And we all talk about this notion that tariffs are a tax, and taxes reduce economic growth. And so for me, I think there's this kind of misplaced fear that inflation will be rising. The second part of this is I disagree with this notion that we're in a good place already and we have time to wait. It's almost as if we're waiting for the accident to happen before we react. And that's what I'm most concerned about. So at 4.25 and 4.5, and your core inflation measure at 2.6, you already have the opportunity to cut rates 3 to 4 times, 25 basis points each, and still be 1% above your preferred measure of inflation. So to me, I think the Fed is too tight. So those are my two big bones to pick with the Fed and my two big concerns here in the next kind of few meetings.
So Mike, let's just put a fine point on this. So you think the Fed is too late and you are much more concerned about growth? Absolutely. I think that the inflation fears are misplaced. I think inflation's cooling. I have the PCE numbers here in front of me. So it was 2.9 in December. 2.7 in January. Certainly, we had a little bit of a hiccup in February. It was 3.0. This is core PCE, what we all claim is the Fed's preferred measure. We're at 2.6, and we had a 0.0 month over month in the most recent month. So the fears, and somebody asked him this during the press conference, the fears are that it's tariffs that will result in an uptick in inflation. There's no other data that suggests that this inflation will tick up other than that. And I just disagree that tariffs will be inflationary. In fact, I think that that's a mistake. It's a mistake they made in 2018. So the Fed never hurries until it's too late, and then they have to catch up. And I'm afraid that that might be the case this time around as well.
Luke, let's bringing you back in here. Do you you've been listening there. Do you share Michael's views and broad concerns there?
Well, I certainly don't think that inflation is a problem. Total PCE down to 2.3%. When you remove the shelter component, which we know has this weird lag that takes a long time to catch up, but the entire PCE minus shelter, the Fed's already been at their target for 12 months. And like Michael, I don't think that there's any threat of it advancing higher. I don't think consumers are in a strong enough place to push inflation higher. I understand why the Fed would be guarding against the upside. If they don't want to make that mistake twice. And then the other thing is, if they're late by one meeting or 2 meetings, there's not a whole lot that 25 basis points or 50 basis points is going to do to help the economy over the course of 7 or 14 weeks. because the recession that we think we're heading into has to do with a very large tax. It's 2.6% of GDP, $780 billion based on 2024 trade. And there's not really anything that the Fed can do to stop that from happening. And if we persist with the tariffs, even if they're 10% on all countries and 25% on China, and we're trying to move things domestic production, well, that's a huge, huge investment move that needs to happen, and it's going to cause a slowdown and sort of a hiccup, and there's nothing the Fed can do about that. So I agree with Michael's assessment that inflation is not a problem and the Fed is going to end up cutting. I don't think that 7 or 14 weeks is going to make much of a difference at all. So that's what I think will end up happening.
Well, Luke, just to drill down into this a little bit for viewers who, it's sometimes hard to understand how exactly the Fed's moves make their way through the economy, right? Which is kind of what you were just talking about. So let's say growth is already slowing. Maybe it's too late. Maybe it's not. When they cut rates, how does that make its way through in this particular moment and environment where tariffs are high and people are concerned? What then does that cutting of rates do for the economy, and on what timetable?
Yeah, they could have a material impact on interest rates. It's more about how they talk about it once they do start cutting, or even beforehand. Everybody gets all over the Fed for not raising rates when inflation had come up in 2021 and 2022, and they didn't hike until March of 23. But they had started talking about it in November, 5 months earlier, and they were able to basically double the 2-year Treasury yield over the course of 5 months before they ever took any action. So when they do get to the point of cutting rates, which is what I think will end up happening, they'll also be talking about how more cuts are likely on the way, that methodical approach that Michael mentioned here. And you would see 2-year yields moving down. That would be somewhat supportive of equities. I don't think it could stave off a recession because we're still talking about a huge, huge tariff tax hike and a big repositioning by companies. But it would be helpful, and you would see it push through if they are communicating about it and communicating that there are more rate cuts coming. You would see it play out in the 12 and 24-month yields, and you'd get some monetary easing there.
Michael, last one to you. The theme of the presser was uncertainty, and Powell came back to that again and again, and needs more clarity and needs more data. I'm just curious for you, Michael, as a strategist, and you're watching the economic data very closely. What's the data on your radar, Michael? What are you watching most closely right now?
So I think there's 3 things to keep an eye on. I think jobless claims is an important leading indicator of the labor market. So Powell went out of his way to continue to suggest that the labor market's been resilient and in good shape. So if we start to see layoffs increase, that'll be an important indicator that something's gone wrong in the labor market. And that certainly feeds through to consumption. The second is credit spread. So we know that high yield spreads relative to treasuries did widen as market volatility picked up post-Liberation Day. They're back to historically tight levels. So we know that we don't really have economic cycles anymore. We have credit cycles. And ultimately, the credit markets are suggesting a fairly benign environment for the economy, which is a good sign, a very positive sign. And thirdly, earnings. And so I know that this one's a little difficult because there's some rear view mirror component to this, but company earnings continue to be quite strong. So year over year, it looks like S&P 500 company earnings are going to grow by about 13%. That's coming off a previous quarter that grew by double digits. And it looks like earnings, although they're coming down some, which typically happens, will be very strong this year. As long as that's the case, those 3 things indicate to me that the labor market and consumers in good shape, the credit market's in good shape, and ultimately businesses are in good shape. Those are the 3 things I'm keeping an eye on.